Welcome back. You're still watching Smart Money on CNBC-TV18. We're talking about debt funds and we're here to debunk a lot of the myths and tell you how and why you should invest in debt funds. We have with us Nasser Salim, the managing partner at Flexicapital. Nasser, thanks a lot for staying with us on the show. You know, I want to talk a little bit about fund managers of debt funds. So generally, when you pick equity funds, you are told to sort of review fund managers, and that's an important aspect, find out what the fund manager's style is, etc. But how do you find out the track record of the fund manager in a debt fund?
So, very interesting question again, Nasser. So basically, what we need to look at is clearly the number of years that a fund manager has spent in debt as an asset class. It's the first and foremost. And one is that. Second thing is what kind of the team that he's kind of employed and what is supporting his research. I think the key fundamental attribute required for a debt fund manager is something called consistency and the patience to deliver. And the fact that, he's not taken very aggressive calls when it comes to credit ratings and credit calls. I think, and I also must say this, Sonia, very loud and clear, if I may say so, that the fund manager will also, by virtue of his fund management skills, will also ideally tell you some ideas about which asset management company that he would ideally like to work with, in the sense that an aggressive asset management firm will possibly not have a very non-aggressive fund manager on debt. So therefore, I think it's very important to kind of match both the fund manager's style with the asset management as well. So for example, there are many asset management companies in the past where we've seen they've taken some aggressive bets on credit, as against some which have not, and those have played out very well. So that's the one of the few key things one needs to look at it from a fund management perspective. And the other quick thing is, Sonia, is that you're buying in debt funds broadly for that asset allocation discussion, Sonia, for that investors do or clients do. Basically, it's done for a strategic reason, for a purpose to get that yield. And it's ideally for a minimum of 3 years also because, debt funds ideally give you that indexation benefit. So if you're putting in a fund for 3 years as a strategy, it may be worthy of at least checking a fund manager's consistency and track record for a bare minimum of at least 6 to 8 years, as in terms of getting a clear view of how he's performed in both, mostly in both interest rate scenarios, where a rising interest rate scenario and a decreasing interest rate scenario. So that is something which will kind of give you.
Is there any platform, any website that tracks the fund manager's performances in specific debt funds? I mean, how do you do this kind of research?
So, Sonia, these are all available, I must tell you, in public domain search engines. There are distributors and RIAs and advisors who use professionally managed, search engines, which give us a clear indication of what is the style of the fund management. Has the fund manager been in terms of number of years? There's something called a manager tenure, and what is the style that he's been used to. So there are many public platforms available, reliable public platforms available to use those and to get a score.
Okay, let's come back to the metrics, right, that we were tracking on how, what are the different metrics in order to gauge whether a debt fund is good or not. Anything that we left out? I mean, something that you'd want to discuss, which is a crucial metric?
So I have two very important ones. Number one is the average maturity, and there's something which I like to introduce in your show called the ultimate Z score. Those two are very, very important because the others are all very, essentially common to the entire fund management theory. So starting with average maturity, Sonia, this is again a very, very important parameter like modified duration and credit scores we just spoke about. So an average maturity is basically the weighted average of all the current maturities that are in a debt security at the fund level. These are weights are the percentages of holdings of each security in the portfolio. That's broadly it. And what average maturity tells you is basically helps investors understand the approximate time in which the bonds in the fund will mature, basically, Sonia. And depending on this duration and the investor's financial goals, which is very, very important here, the investor can choose to invest in which funds that mature in the appropriate time to avoid mark-to-market losses. For example, if I were to invest today with an average maturity of a fund, which is, say, close to about 4 years, but I need funds in, say, 1 year, that's a clear mismatch in terms of your average maturity number and your goal to kind of meet that objective. So therefore, that's very, very important for investors to match their goal with the average maturity of the fund, and therefore it's an important parameter. The second one, I would like to shed some possibly a minute or two on, Sonia, is something which is it's not easily available. So this is something which you have to hunt out and dig out, and this is called the Altman Z score. It's a very interesting score, Sonia, and what it basically tells our investors is that it analyzes performance of bankruptcy, basically the probability of a company going bankrupt. So basically, this kind of predicted the major 2008 issue of Lehman Brothers and the financial crisis that we saw in 2008. And what it basically tells you is it uses broadly 5 metrics. It uses profitability at an entity level. It uses leverage as a metric. It uses liquidity, solvency, and it basically predicts whether a company has a high probability of being insolvent or not. As simple as that. And a score, and it's got obviously various parameters in terms of scoring. And I must tell you that Professor Edward Altman, he's the gentleman who developed this way back in 1967. And today, and originally it was actually only for manufacturing companies, but today he launched something in 2012, an upgraded version of the Altman Z score, which is basically called the Altman Z Plus score. And what it does is it evaluates both manufacturing and non-manufacturing companies in terms of its corporate credit risk. And this is something which can be done for a lot of our investors who are investing in single bond papers, in single bond issuers. It's important to kind of go through the numbers to understand a score of greater than 2.99 is safe from bankruptcy. Sonia, I must tell you, a score of 0, for example, is a loud shout, and a score of less than 1.8 carries a high risk of bankruptcy. So, this is a very, very important parameter. And I must tell you, Professor Edward Altman went through over 250 companies in analyzing their balance sheets, in understanding why they were distressed, and therefore the score has come out. So this is something which one should kind of look out for and try to get access to.
All right. I think we need a special show, right, to understand this Altman Z score. But it's very important. I mean, if it helps you tell whether a company is going to hit bankruptcy or not, that's the most important internal to track, especially when you invest in debt funds. But thanks a lot, Nasser. We've run out of time, not out of questions. Very good learning on how to approach debt funds and the do's and don'ts. So thanks a lot for joining us. With that, it is a wrap on this special edition of Smart Money. Thanks a lot for watching. Have a great weekend.